We cover around 17 consumer discretionary stocks in there, so we won't be able to cover off on all of them. Be a bit of speed dating, but we'll try and set the scene. So just first up here, where we are today, the consumer discretionary stocks are trading back at just over 14 times. So they've rallied nicely, really since the end of 2017. More pronounced, I guess, the recovery has been since Christmas, when that anecdotal kind of commentary started to come through that Christmas, wasn't as dire as perhaps some were expecting. In terms of the key themes, where I was expecting this reporting season, so again, we think a late surge in spending has saved Christmas, the key Christmas period, for a lot of retailers out there. But that is coming after on the back of a pretty tough November and early December kind of period. As always, we do expect some pockets of retailers will be, more strong or have more strength in them than others. And for varying reasons, some are simply cycling a really low base in the PCP. Some are experiencing new product releases like the iPhone 10, and some are just experiencing some really strong category trends. We also, as always, expect some pockets of weakness, and we see these really coming from the automotive and motorcycle industries. That data's been coming out for a good 6 to 12 months now, so no real surprise there. But also those with meaningful skews to the second half, like a Domino's. We're also starting to see some chunky consensus upgrades coming through. They're really on the back of, the Amazon bears from around 12 months ago that slashed 15-30% off some of their earnings forecasts in the mass market retailers, who are now coming back to where the rest of the market has been, which is lifting the sector a bit too. Headwinds obviously remain. Amazon, which I still think will be a medium to long-term threat for the entire space. We've still got the cooling housing market. We've got out-of-cycle mortgage rates and rising utility costs. We've been mentioning these for some time, but we're also starting to feel a few tailwinds out there. And, perhaps, household income growth could be bolstered by a couple of things, improving employment and even some wage growth for the first time in many years. We've seen recent upgrades from those stocks we mentioned there, Lovisa, Adairs, Noni B and Kathmandu, but we've also seen some downgrades. So it just shows that there is still some pockets of strength and weakness out there, and we've just got to pick where to be. In terms of the report and the rating changes, we made 2 upgrades in the report last night, AP Eagers and Beacon, both up to adds. We've downgraded Automotive Holdings and Super Retail Group to holds, but we can touch on that a bit later. In terms of our playbook, and I'll just list these names and then we can get into the detail a bit later. So setting aside the companies that have already upgraded, who we think can actually beat at the first half results, we've listed Apollo there and JB Hi-Fi. Most importantly, though, those that can come out with a pretty reasonably strong trading outlook. We've listed Apollo, Adairs, Bapcor and Beacon. And where we ultimately think people's FY18 consensus forecasts or second half 18 forecasts can be beaten, again, Adairs, Bapcor, Beacon, Lovisa and Noni B. And where we see some risk at the first half results, we've noted there Domino's Pizza and Motorcycles. Again, we'll run through them in more detail. So I guess running through our top picks and where we see some upside risk. Firstly, Apollo, and we've been banging on about this one for some time now, and I suppose it's not as cheap as it was or it has been over the last 6 months, but we're still pretty confident on this one. So I guess at the result, we think, that it will show enough momentum for people to have enough confidence to perhaps see some consensus upgrades. Why? I think that the upside will have to come from the acquisitions they've made over the last 12 months, particularly in those new sale businesses like Sydney RV, Kratzmann's, George Day, etc. I think there'll be more momentum there than perhaps the markets are factoring in, but also potentially some efficiencies from those that new manufacturing facility that has come online in Brisbane. I'd also point out that the New Zealand and North American markets remain very buoyant. Just on that new manufacturing facility, and we went and toured this pre-Christmas, the company's only ever guided to additional rental costs in relation to this and never really guided to any potential efficiencies or synergies or upside. And I'm not sure if they'll do that at the result, but I think at some point they'll probably have to talk about this because it's pretty evident that there are a heap of efficiencies that can come from that new production facility. I also see a couple of key segments in the market these guys aren't in that could move the dial on the earnings front in the next couple of years. Firstly, a potential move into servicing at some point. This is a very large market in the US, dominated by only a couple of players. And in Australia, it's really fragmented and kind of mum and dad shops running this industry. And I think this is something the company will definitely move into. Secondly, they're not really an F&I at all, particularly in the new sales side of the business. And one of the businesses they recently bought are quite good at it. I think that's teaching them some lessons. It's obviously higher margin product despite the regulatory headwinds. And I think that's something they could move into too. I'd also note the US tax cuts to come through will obviously be of benefit in time. So, look, it's not as cheap as it was, but on a PE kind of pre-amortization, it's still sub 14 times. It's really got some solid double-digit growth for a couple of years at least. And I think we're just really confident that these guys can exceed our forecasts over the next couple of years. So earnings momentum there is key, and its key peer or its closest peer, Tourism Holdings, still trading at a slight premium to it. Secondly, on Bapcor, so it's been like a preferred pick of ours for some time, and we're maintaining that there. I don't necessarily expect a big beat at the first half result. There is a bit of a skew to the second half, but I still have comfort they will eventually exceed their FY18 forecast and consensus. Anecdotal feedback we're getting is that the entire automotive industry traded very well throughout December and into January. That's both the trade and the retail side of the businesses. And most of those players are now being able to pass through price increases, and that's a real positive in this competitive market. I think they might start to mention this Asian trial. I think they'll roll out a few more stores in places like Bangkok in the second half. Now, it is a trial, but they're doing it in conjunction with their key suppliers, the big global OEMs that just feel like these markets, like Thailand, are so unsophisticated and just ripe for consolidation. So I don't really want to price anything in for that yet, but it's nice optionality. And as the company said, it could dwarf the entire business's current earnings in time if it works. So in terms of the outlook, I just think they'll reiterate that 30% growth. Again, I think they can beat it. This company has been really acquisitive, and now it's time to optimize, and there is so much they can do, and they haven't even scratched the surface. So you're going to get another 4 years yet of nice synergies coming through that will really bolster what's already a defensive but growing earnings stream. I just also wanted to point out here, about mid last year, company came under a bit of pressure as the offshore peers really weakened. Some of them had some earnings hiccups, but most of them were weather related. So their PEs and share prices really came off, as you can see in that first red circle. What no one's talking about now is since then they've absolutely ripped, and now they're outperforming Bapcor, and that's the share price in the grey line of the US peers, and Bapcor in the blue. And here's the PE. So actually, Bapcor is actually screening well on a relative basis now as well. Moving on to Lovisa. So, I put this one back onto a hold too early. So we've moved it back to an ad here. They recently upgraded, so you're probably not going to get a heap of surprises at the actual result. So any positive reaction would really need to come down to management's commentary on their trial offshore operations. So here we're talking about Spain and the US, and that absolutely could happen. When we spoke to Steve Doyle around the time of the upgrade, he was pretty darn happy with how the US was kind of proceeding. I mean, it's only one store, but this could be a massive market for them. We've actually gone and made some additional FY18 upgrades in this note. We had a real look at our second half earnings, and they just didn't, ask a lot for the company to actually perform. The operating leverage was nowhere near what it should be, so we've gone and upgraded, and they've already delivered over 70% of their full year earnings in the first half, so your earnings risk is low. But as I say there, let's face it, the current share price requires you 100% to believe that they can execute in offshore markets, so you have to believe, and we do. Shane Folshier has worked for a very long time in the US. It's a perfect market for these guys. It's 13 times our population. There's really only one big competitor over there, and they've been having a lot of troubles. They've got 1,500 stores over there. So when you look at Lovisa, I think the US could easily have 300 stores, the UK up to 100, and then Spain probably 30 or 40. Even if you factor in just a US rollout up to 300 stores, you can get a DCF well over $10 for this stock. The other thing Lavis is benefiting from is a major shift towards this affordable fast fashion jewellery. People are far more prepared to spend $20 on a pair of statement earrings than a couple of $100, wear them a few times, move on to the next fashion trend, and I think that will continue. Again, quick store paybacks, less exposure to Amazon risk, a lot less exposure, and potential large-scale global rollout sees us be pretty positive here. Just some other stocks we're watching at the moment too are Dares. We still think 100% they will have to upgrade in the second half. And in that note, I'd refer you to when you look at the second half, it implies nothing in the way of operating leverage. It's like 10 basis points, which just won't occur in our view. So we've gone over the top end of their EBIT target range, and I still think that they can beat that again. So I think probably another 5% upgrade to the top end of guidance is likely in the second half. AP Eagers, we've lifted that one to an ad after a long time on the sidelines, and it's not because we're seeing green shoots in the automotive industry. It's because this company sat back over the last 12 months during a really difficult time, ripped out costs and restructured the business, removed loss-making businesses, which just means that it's going to be so much better leverage when conditions turn, and they ultimately will. I'm just not saying it's near term. So look, we might have gone a little bit early, but when this thing goes, it goes. And I just think they're going to be a lot better positioned going forward to grow. Baby bunting. So this is one we've had on an ad. It's gone against us with that recent downgrade. And we might actually get a few more false starts before hopefully we're eventually right with this one. But I do think this is the one that will be a massive performer for us at some point. It's just a little bit difficult because all these little independents are going out of business every day, and that creates a clearing of stock, inventory flushing around the system, and a lot of discounting. But we've spent a lot of time talking to offshore peers, some offshore suppliers, and we really gained confidence that the suppliers will absolutely support the big category killer in this space. And in fact, one of them said there's no reason why baby bunting shouldn't always have the best price and the most exclusive product versus an Amazon if they're the number one player in their market. So look, I think you can probably wait for this result just to triple check, although there shouldn't be any surprises given the recent downgrade. But there's a couple of really key things we're looking at. The suppliers are starting to support them, and there's a big revenue opportunity here from all these players falling by the wayside. And lastly there, JB Hi-Fi, look, I think that's been very well documented. They're likely to have had a very strong Christmas. The iPhone and flat panels really helping them there. Definitely a chance they could upgrade modestly at the result, but up here I think it's priced in. So where we see the risks, just there on Domino's, management's pretty clearly told the market on several occasions that the earnings growth skew will definitely be to the second half for a couple of reasons, mostly because ANZ's skew to the second half this year, well, it has to be. But I think so perhaps that won't disappoint the market. Everyone's expectations are already there. But just to give an example, we're forecasting 12% growth in the first half and nearly 30% in the second half. So, you won't get guidance validation until the full year result. But where we're kind of worried is on the ANZ same-store sales guidance. So they're guiding to 7 to 9 for the full year. I think they'll do 4.5, maybe 5 in the first half. So they've got to accelerate to 9 in the second half to even hit the bottom end of their same-store sales guidance. And I'm just a bit worried their menu innovation hasn't been as perhaps strong as it has been in recent years. So I'm concerned the market sits there and goes, oh, guys, that's a big job to do in the second half, and maybe there's a chance after this little rip that it underperforms. That said, short interest has come down a bit, but it's still over 30% of its free float, so it doesn't have to do much to see a big squeeze. But no buyback has been done since early October either, which is interesting, so we'll be looking for a commentary on that, but just a little bit cautious on that one going in. And there you can see the relative performance. When we'd previously upgraded it, DPZ, its parent, was trading at a decent premium. It's now trading basically in line with Domino's here on the next 12 months PE. Just motorcycles, we see a bit of risk there at the first half result. Again, we've had quarterly updates from the FCII data, so it's not a big surprise. But when you get an industry down 20%, you get a decent amount of earnings squeeze here. So look, there's a risk the first half result underwhelms, but you've got the acquisitions kicking in the background, which should see it meet last half's earnings. I would also point out that they are cycling a monster first half. Their new bike sales are up nearly 25%, which is just unheard of. And then they're cycling a very weak second half. So I wouldn't discount that they can come back in the second half here. We're sticking with it. We think the acquisitions are still coming through and the industry won't stay down 20% forever. So just in summary, I mean, economically, there's headwinds, but for the first time, we're seeing a few tailwinds coming through too. We absolutely still believe Amazon is a decent threat on the medium to long term, but as we've also been saying, it wouldn't impact straight away, and I think we're seeing a bit of a relief rally in these stocks from that. There are still pockets of opportunities. Who would have thought? I've just mentioned a whole lot of upside earnings risk for this sector. Who would have thought there were so many players? So we're just sticking with those that are niche specialty retailers with dominant category pillar positions that have solid growth outlooks, to be frank. And the key picks there we've mentioned are Apollo, Bapcor, Beacon, and Lovisa. But we also see really solid medium-term value in AP Eagers and Baby Bunting.